Good evening to Dr. Diana and my fellow friends. Today, myself, Shalini Devraj and Siti Shuhada will be presenting the article named Multinational Transfer Pricing, a Transaction Cost and Review-Based View. So I will talk about the transfer pricing policy, which can help M&E take advantage of complex international market imperfections while managing costs and risk. Actually, transfer pricing also stands as the heart of the M&E in management control system. Transfer pricing refers to the price placed on goods, services, and intangibles as they are moved between economic entity of M&E. In the picture that you are seeing now, Enterprise X is a manufacturer of pianos in Malaysia, whereas Enterprise Y distribute these from Hong Kong. Both X and Y are 100% owned by Enterprise Z. Since Z participate directly in the capital of both X and Y, they are all associated enterprise. When selling their piano on the market, Z has no control on the price at which one piano is sold. Reason is that the price are set by supply and demand. Currently, the market price for one piano is USD 5,000. However, S does not control any transaction between X and Y. Therefore, the internal sales of a piano by X and to Y is called as a control transaction. This price charged for the transaction is called as a transfer pricing. Transfer pricing policy is particularly difficult for a M&E because they need to not only determine a transfer price that is in the best interest of the organization and the individual entity in the value chains, but also one of them will satisfy the regulatory requirement of a host country where foreign divisions are located. This problem is compounded by the decisions of where to locate worldwide resources in order to exploit market imperfections and maximize the organizational value chains. This decision will be determined by the nature of the product created, market structure, environmental factor, including the tax policies, relative power, and dependency among the entities, government's procedure, socio-economic and geopolitical risk, transaction risk, and the nature of the resources used to create value. There are two theories used in this article, which is first, I will be presenting the transaction cost economy, which is known as TCE. So it focuses on the transaction costs associated with the cooperation among the entity, emphasizing the potential downside or risk associated with the interactions of entity in value chain. They are focused on the two important factors, which is transaction costs and opportunities behavior. Transaction costs include the coordinate costs of exchanging emotions and incorporating that information into the decision process, such as searching for partners, negotiating and writing the contracts, monitoring and enforcing contract compliance, and dispute resolution. Next, an exchange relationship may be guided by self-interest consideration to take the advantages of others' entity in a value chain. This includes such behavior as cheating, lying, subtle form of violations in agreement, and using the leverage to take unfair advantages of trading partner. The opportunistic risks are often called as the relational risk. Relational risk may cause a firm to incur monetary costs to monitor activities, safeguard assets, and make sure parties to take transaction to not engage in opportunity behaviors. From the article, we can know that TCC tend to focus on the contractual view of governance and does not consider other organizational and relation control mechanism for coordinating activities, business process, and related governance structure, or the dynamic of social mechanism among the business partners. Unfortunately, these contracts are incomplete due to the many risk factors. For example, product, market, environmental also, which are present in any relationship between the entities, as well as the human limitation of bonded relationship. Next is the second theory, which is known as review-based view. It focuses on this strategic benefit of cooperation among the organized entity. The resources needed to convince and choose and implement strategy are likely to be heterogeneous distributed among the entities. RBV view the firm as a broad set of resources consists of tangible and intangible assets that are unique. It follows that similar win-win benefit can accrue to the entity which an intra-organization value chains as a default division through vertical integration create value for the pooling of their resources and capability. Besides that, value chains can be formed through the vertical integrations to create the value from the pooling of resources and capability to the entity as they leverage each other's scarce and intangible resources to maximize their returns. Governance activity from RBV focus on the social and political relationships, such as those based on policy, routines, procedure, trust, and the repetitions for a discussion of trust and repetitions. To facilitate the effective communication, an information system IS can be an important value advantage resources, and IC facilitate the coordinated of activity and the flow of information, as well provide a basic sorry as well as provide a basic of relationship among entities. In general, RBV focus on value maximization through the effective resources. As a result, tend to be considered more of strategic approach to value chain management than TCE, which focus on maximizing risk associated with the transaction cost. Okay, these are the framework show that transfer pricing in context of TCE and RBV, illustrating how TCC and RBV theory are antecedent to the transfer price, and then how the transfer price have the consequence for the TCC and RBV. I will be presenting in the next slide. So, TCE antecedent factor. First is the nature of the value chain. Nature of the value chains for each product line of the entity can affect the transfer price. Many of the traditional recommended OECD, which is 2001-2019 MENE transfer pricing procedure, really on the comparable informations for the product at a similar level of product completion. Comparable information is difficult to obtain and rarely founded in database. Partial recognition of these issues is seen in regulations regarding the methods recommended by the OECD that use the comparable market. Issues included determining which functions are to be performed by the buyer and the seller, contractual terms risk that could affect the price of profit, economic condition, and the nature of the transfer. The nature of the product and the distribution process is of the particular important for a TCE perspective, because this is the where of many of the performance risks occur related to the value chains and the potential distractions. Costs that are associated with the flow of the coordinate information. Those associated with the sales order, inventory, and just-in-time system on the procurement side, as well as the flow of the funds on the payment sides of the transactions are also related to the performance risk. Okay, next is the nature of the complexion. The nature of the market for the each entity intermediate product can affect a transfer price. The traditional arm's length principle, which known as ALP, is the international benchmark for the transfer pricing. It is appropriate. It is appropriate only when the market is perfectly competitive, and there exists in the external market for an intermediate product. Next is the environmental factor. Environmental factors that may be relevant included credit risk associated with the market, currency fluctuation, and the interest rate, business risk related to the property, plants, and equipment, economic condition, size of the market level of markets, market shares, industry conditions, alternative available, and the nature of the property transfer. These environmental factors differ widely from one legal entity, country to another, and comprise another important of the M&A market imperfection. Next is the government structure. Government structure are affected by the complexity of the organization value chains as well as uncertainty in the business process. These government structure are the responsible for the flow of the goods and the service complex, sourcing, integrated manufacture complex, distributing channels, financial resources, risk management, such as dealing with the warranties and the account receivable, and generations and coordination of the intellectual capital toward the organization. The degree of the authority and autonomy given each entity, as well as the market characteristic, may also affect the decision regarding the appropriate of a transfer pricing. The relative power and the degree of dependency among the entity that are comprised the value chains can be affected transfer pricing through the opportunity risk. This is known as relative power and degree of the dependency. Opportunity risk is the likelihood that the one entity may take advantage of the another by the virtue of its leverage and exploits most of the profit and the itself, whether it's an individual entity or product line or the legal entity. Opportunity risk may be a function of the alternative option for the buyer or the seller, which has the bearing one of the entity dependency or another. If one entity, for example, has no alternative other than to sell inside the organization to another entity, it may be leverage of it transfer pricing negotiation compared to the entity that has another option whether to buy its intermediate product. Next is the TC antecedent literature. The most common understand concern of the management whether deciding on the transfer pricing in the minimizing of tax is accomplished by the shifting and inward toward the lower tax rate and away from the higher one. According to few articles, there's a few arguments done by the researcher. Based on Kelsen, Wang, and Son on the 1993, they found that M&E shift income from the higher tax region to the lower regions, which is changing the relative tax rate. They have found that the extent of the income shifting in the general significant both statistically and economically. An empirical analysis was done on the Bureau of Labor Statistic data on the export and import price was undertaken in the order to understand whether there was the evidence of the tax motivated transfer pricing for the intra-firm trade. In particular, next is the closing 2013 set out to determine whether there was evidence that the price of the intra-firm trade transaction were sensitive to the tax rate to the country in question. The results found that direct indicating that the intra-firm trades price are likely influenced by the tax minimization strategy of the multinational firm. strong and statistically significant relationship between the country tax rate and the price intra-firm import and the export traded is that country, which I already explained in the one of the analysis done in the empirical bureau. In particularly, there was and then the next is the according to Wagner 2011 examined there are three base transfer pricing regimes and consider uncertainty risk of in their models. First is the centralized standard cost transfer pricing dominated others method in the ex ante cost uncertainty insufficiently low. Next is the reported standard cost transfer pricing dominating in the ex ante cost uncertainty in the sufficient high and the buyer doesn't not obtain the cost information at the trending stage. Last is the actual cost based on the transfer pricing become the superior method in the ex ante cost uncertainty in the sufficient in the high and the buyer is sufficiently well informed about the supplier costs. The OECD called for the centralized standard cost-based transfer pricing is ex ante uncertainty in high. However, it is uncertainty is low. OECD suggests firms use the transfer pricing based on the historical cost. For your information, ex ante means based on the forecast rather than actual result. Based on the Weissman 97 analytical examine two transfer pricing regime on the perfect information between all parties and the others which with communication limitation. The relative power and degree of dependency among the entities that comprise the value chains and also affected by the transfer pricing to the opportunity risk. If one entity from, for example, has no alternative other than to sell inside the organization to another entity, it has the little leverage if any transfer price negotiation. Another entity might have a robust market for its intermediate product, thus its leverage rises. Next, according to the Colali and Weissman, 2016 find that cost IT, for example, summary and not detailed information prevent divisional manager from transferring lack knowledge about the firm production and process. A cost-based method provides a high profit then negotiation transfer pricing was established. According to ELSA and Data 98, assume that the decentralization firm decisions are made by the market departments. Yes, they had concluded that maximizing profit, the market department needs to obtain cost information from the cost system. As a result, the cost information that is reported become a component of the price determination. According to Alman and Actor 90, empirical find that legal constraints and the firm size are significant determinants of the transfer pricing strategy. Next, Chan and Chow 97 studied the government tax audit of the transfer pricing practice involved in 81 MNE. Revealed that the tax rate different does not appear to be a major consideration for the transfer pricing manipulated by the company with an adverse determination in the tax audit. Other factors such as foreign exchange control and the risk devaluations of the local country may be placed on an even more prominent part in the MNE transfer pricing decision because of the potential to affect the performance risk. So now I'll be passed to my partner, Shuhada, please.
Thank you, Shalini. Thank you, Shalini. Good evening to Dr. Dayana and everyone. My name is Shuhada, and today I will continue on the transaction cost economic or TCE consequence factor. So, in general, consequences of transfer pricing policies affect many aspects of an organization and its value chain, whether they are external market where an arm's length standard can be applied, or whether another method is needed to imperfect market. The transaction will be affected by the transfer price, which is applicable under the OECD guideline, and also the tax regulation, which is appropriate for each legal entity country. So there are 6 TCE consequence factors. These are contract and income distribution, TCE motivation, minimize transaction costs, opportunism, TCE coordination of value chain activities, and TCE risk. So first TCE consequence factor, which is contract and income distribution. The distribution of overall firm income among entities is actually the most obvious effect of a transfer price, and transfer price also affect the buying and selling decision by entities, as generally noted in most management and accounting, as such as how much to buy and sell and whether to buy or sell internally or externally. So actually each of the above consequences has contract implication. Second is TCE motivation. So transfer pricing policy in this case can affect the motivation of entity managers. Often behavioral managerial objective, which is motivation of employees from individual entities, conflict with the usual goal of maximization of net income. Indeed, sometimes suboptimal businesses decisions are made as a consequence of tax compliance. The third TCE consequence factor, which is minimize transaction cost. Transfer pricing policies actually can affect the transaction cost, which is performance risk and opportunities risk. In this case, the transaction performance risk is actually related to the flow of goods among entities and management of financial resources of the organization. And in this context, the transfer pricing policies may lead to the suboptimal business decision, which affect the overall value of an organization. Fourth, TCE consequence factor, which is opportunism. So transfer pricing process actually can affect the degree of opportunism among entities. Indeed, if the process is not fair, one entity can opportunistically extract the rents from another due to its political or economic leverage. The fifth TCE consequence factor, which is TCE coordination of value chain activities. Opportunity behavior can result in adverse consequence for the relationship between the entities. For example, coordination of value chain entities may suffer because one entity may accrue all the income from the relationship or investment at the expense of the other. Next is TCE consequence literature. Actually, this study have highlighted many literature on the TCE consequence, and one of the TCE consequence literature is studied by Borkowski in 2006. The study has found that the transfer pricing expertise is difficult to find, so high-profile law firm and accounting firm have vigorously recruited for advanced pricing agreement director. So the next study another study by Wegener, Sansing and Wilhower in 2006, the study have used a strategic tax compliance model in order to examine the effect of inconsistency in the application of arm's length transfer pricing method among taxing authorities. And the result of the study show that there is greater inconsistency from the authority list on average to a decrease in firm tax liability as a consequence of organization trying to set the transfer price to their advantage to minimize the transaction cost. Another study by Williamson in 1985 state that the inherent problem of conflict between the divisional and firm-wide interest is characterized as an investment hold-up problem. In this case, two divisional managers engage in interdivisional trade, and both managers are actually risk-averse, effort-averse agents who negotiate a contract between themselves. So each division manager is concerned about getting a bonus for his own division and has to balance that concern against the good of the firm as a whole. So realism also determines that the firm-wide performance evaluation is necessary unless one manager somehow capture the entire surplus from interdivisional trade. So this result explains that the importance simultaneously of the transfer price, the performance measure, and also the power of negotiation. Next is RBB antecedent factor. There are 5 factors. These are RBB nature of value chains, nature of resources, market imperfection and competition, RBB environmental factor, and governance structure. First RBB antecedent factor is RBB nature of value chain. So the nature of or structure of the value chain determines in large part what flexibility a firm has in vertical collaboration and integration. So when a firm vertically integrate, it is usually to increase the efficiency or create the structural impediments to the competition. And the strategic assumption is that it is often advantageous to the firm to own more link on the value chain. That is, it may become cheaper to make than buy. So transfer price also mediated the functioning of intra-firm collaboration, and the resource-based value of the intra-firm valuation is based on the inimitable strength of the firm, and this strength rely on the relationship among entities, and thus the transfer price will play an important role in governing this relationship. The second RBB antecedent factor is nature of resources. So in order for a firm to erect the barrier to entry, structural impediment, they must do something unique that is also difficult to copy. And one way to create a structural impediment by vertical integration is to uniquely control the valuable rare resources, whereby these resources may be physical, economic, informational, or relational. So the decision the firm make as how to use these resources within the firm will help determine the transfer price between entities. For example, the location of production resources internationally or domestically will affect the transfer price between these entities. Third RBB antecedent factor is market imperfection and competition. In this case, care needs to be taken in forming the transfer price to take advantage of market imperfection, which is resulting from the use and location of these resources. Next is RBB environmental factors. So actually barriers can be erected based on the legal and regulatory environment facing the firm, which may affect the use and location of valuable resources, and a firm on the outside of a heavily regulated industry has a difficult time breaking through, while a firm on the inside has a significant advantage. And the last RBB antecedent factor is governance structure. In this case, the lack of a competitive market for intermediate product makes it difficult to form the transfer price, and from a strategic planning perspective, this allowance for judgment actually gives management choices as to where they want to locate the economic resources. And this judgment is usually codified into a governance structure, which affects the use and location of these valuable resources. Next is RBB antecedent literature. The study as well highlighted many literature in regards with the RBB antecedent, and one of the literature is by Kasici in 1981. The study has recognized the importance of the resource location using a single objective model, whereby the model was developed using an iterative process depicting the transfer pricing decision setting of a multinational enterprise. And the final model depicts a multinational enterprise maximizing worldwide profit, such as relevant profit tax differential, tariff, and so on. Another study by Dunning in 1980 stated that market advantages are not uniform by industry, and thus industry structure must be taken into consideration when deciding on the location of resources before making transfer pricing decision. So, sorry. So next, there are 5 RBB consequent factors. These are maximized value of organization, location of resources, RBB motivation, RBB risk, and RBB coordination of valuation activities. So first is maximize value of organization. So maximize value of organization is not always synonymous with maximizing short-term profit. And even though profit are considered as an important metric, these metrics are not always totally congruent with business strategy and overall long-term value. Second is location of resources. So viewing the company as a bundle of unique resources, the custodianship of the resources is paramount to long-term success. So these resources will grow or shrink in part due to the policies of the company. And to conclude, in the context of location of resources, entity profitability is heavily influenced by the transfer pricing policy. Third is RBB motivation. In many cases, the transfer pricing policy also can affect the motivation of entities. In agency theory, tells us that an entity will not push to produce the maximum amount of an intermediate product if its employees are not receiving a portion of the profit from their work. And as a result, the acceptable tax policies, according to OECD, may have unintended consequences for the firm as they affect profit sharing, thus affecting the motivation of employee at the entity level. So next is RBB risk. So acceptable tax policies may encourage firms to locate their assets suboptimally, which increasing the long-term risk. And the last factor is RBB coordination of value chain activities. So value chain coordination require information sharing and the organization of production activities so there is an effective flow from raw material to completed product. So the factor which enable precise transfer pricing also can enable this coordination. And last is the main enabler to both are effective record keeping and effective communication between the entities. So next we move to the RBB consequence literature. A study by Dopush and Drake in 1964 have found that a single measure of performance such as profit and loss index not sufficient for the transfer pricing. And they also conclude that the relationship between the decision making and the control and evaluation phases of managerial function be kept in the forefront in considering the design of accounting center. So another study by Harperin and Srinidhi in 1991 have found that the use of the resale price and cost plus method for internal transfer pricing distort the resource allocation pattern both under unconstrained optimum and centralized optimum assumption. So the result demonstrate that the type of production and resource location distortion possible in a decentralized organization using generally accepted transfer pricing rule. So in conclusion, M&A's multinational enterprise must make many strategic and tactical decisions in order to coordinate their intra-organizational value chain activities. In strategic decisions include but are not limited to what product to produce, where to produce it, and how to get the most out of limited resources. In tactical decisions include but are not limited to how to create incentive to coordinate the value chain, how to control the quality across the value chain, and how to limit the transaction risk. And how to distribute income among divisions to fairly evaluate and motivate managers in a decentralized organization. Second, transfer pricing policies is used to mediate these activities, which is affect both strategy and tactical decision. So transfer pricing policies is affected by the nature of the value chain, including the product and service that are produced, market, environmental factor, which is include the tax and regulation, the power and dependence dynamic, the resources, governance structure, including divisional relationship. Third, transfer pricing policy also affect the coordination of value chain activities, opportunities behavior, the location of resources, risk and motivation. And for this reason, the transfer pricing decisions are of paramount importance to multinational enterprise. And in addition to this factor, there are often multiple objectives to consider which make multinational enterprise transfer price policy decision, especially complex. So that's all from us. Thank you.